It's October 31st, it's Halloween, it's a Fed week, and I want you guys to be ready for this Wednesday, November 2nd release of Fed minutes after the meeting completes. All right, so if you want to ever check on the Fed meeting calendar, so we're getting towards the end of the year, if you want to look ahead and see what it's going to be for 2023, the website you want to stay on top of is here, federalreserve.gov/monetary policy /FOMC calendars. The two C's there might get you, okay? So now we're going to go over to the charts. Before we do that, super quick reminder, trading and investing can be extremely risky business. Therefore, it's your responsibility to evaluate any information, opinion, advice, or other content contained in my video. Right now, what I'm going to look at with you is the E-mini S&P 500 December contract of futures. And let's take a quick walk through what is going on in the futures as it relates to the Fed hikes. Let's look at the current price action, and then let's look at what we can expect into and around the upcoming Fed meeting. So if you take our eyeballs all the way to the back here, you can see that back on March 16th, when there was a 25 basis point hike, this Z contract wasn't super active, right? It was not the front month, but the market really sailed higher from there. And if you're new here, I'm Hima Reddy. The E-mini S&P 500 futures is one of my babies, my markets I love to trade, analyze, and share with my tribe. And I use price, time, and momentum analysis to help boost trading. So you can see that we had that run up, and then we had the series of rate hikes continue to progress. And now we've been at this steady 75 basis point clip. The first thing I want to remind you guys of is that if you look at this, you can see there's no fixed reply that the market has to a Fed rate hike. There are other factors that are going to go into it. So if you're newer to trading and you're like, oh, when the Fed hikes rates, the market goes down, easy. Not so easy, okay? Look at back here in September, yes, that happened, but look at back here in July, it traded higher from there. And in June, it traded lower, but then it whipped higher. So what this is telling me, and should be telling you, is that it depends on the trend of the market coming into the rate hike, what the reaction may be. So let's kind of compare apples to apples here. Let's focusing on the most recent action. So these are candlesticks every session representing 1 day of price action. I have my favorite indicator for momentum down below, RSI power zones. Now you can see we've been trending higher in this channel that I drew between the October 13th and October 21st lows. And then I projected it from the October 14th high, okay, to give me an idea of how price is moving. Now, if I kind of focus in a little bit, let me ask you this, guys, okay? So take a moment, answer in your head, and then I'll proceed here. Is the November 2nd date that we're coming to, is the price action coming into it more like what happened in September or more like what happened in July? Just comparing those two. Yeah, I would argue that it's more like what happened back in July. The market was in a recovery mode, okay? Now notice the market was recovering higher and made several notches higher, as we have seen here. However, the recovery amount of time into the July rate hike was a lot more time than what we're seeing on this likely rate hike into November. So what this is telling me is if the expected rate hike happens, the 75 basis points, then I think we may just continue to chug along higher in this channel, unless and until we break one of the recent higher lows. So you have that. So you guys can draw it on your chart. And if you don't trade the E-mini S&P 500 futures, you trade the SPY, or you trade the big S&P, or you trade the micro ES, translate it over. The dates are likely the same, okay? I'll tell you again, October 13th, October 20th, project from the 14th high in the middle. Now, if there's some unexpected action, okay, especially if the Fed hikes rates even more, like if they do 100 basis points, not likely as of this moment, but if they do, well then, I would think it's more likely that the market pushes lower. But you don't have to worry about that if you use the boundaries of the market to guide what you do. Meaning, so long as we are up and to the right in this little channel here, you can buy on dips and exit on the bounces toward the upper bound, okay? It's not going to last forever. It never does. But it can last a long time and really guide you as you follow along the action. All right, well, that's what I'm seeing here. Definitely go and draw this channel on your S&P market that you're watching. If you are watching another broad market, see if you can translate it to comparable highs and lows, and we'll see what the Fed has to say coming up on November 2nd of 2022. Catch you on the inside. You can sign up at the link to get my hot, timely, actionable updates as soon as I publish right to your inbox.